Like most Americans, federal employees overpay in their taxes. And this is generally because they don't understand the tax code and what they should be doing to reduce their tax bill. Now, federal employees have some really unique benefits that they get for government service. In this episode, I am going to cover some of the common things that I see over and over again and that you should be taking advantage of to reduce your tax bill. Welcome, I'm Ed Smith, President of Valor Wealth Partners, where we're dedicated to educating federal employees on how to maximize value from their complex and often underutilized benefits. Taxes are a really big topic. You have taxes for almost everything. There's a state tax, there's taxes on gasoline, there's taxes on alcohol, there's taxes on almost everything that you do. So we're not going to talk about all of them. We're only going to focus on two of them. Federal taxes on an income tax and capital gains tax. So again, we're not going to talk about the state-specific taxes and where you possibly could live in retirement, which might be beneficial for you. We'll cover that in a different episode. But we really want to focus on federal income tax and capital gains. To start off, I'm going to give a small class just to give a summary and bring you up to speed on what that is. Now, I'm not an accountant. We don't file taxes, but this is general knowledge that I have had for many years of working in financial planning with clients. Let's first summarize the federal income tax. It's also known as the marginal tax brackets or marginal tax rate. Now this bracket starts off at a 10% number, then goes to 12, to 22, 24, 32, 35, and then finally at 37. So if both you and your spouse are GS-12 Step 6, that makes combined income around $181,000 a year. This means you'd be in the 24% marginal tax bracket. What this doesn't mean is that you pay 24% on all of your income. Your first portion is taxed at 10% and then at 12%. So you can see it increases over time. So only the last part of your income is actually taxed at 24%. The overall tax you pay is what's known as the effective income tax, and this percent might be only 15%. I don't want to get into the weeds too much about deductions and everything, but there is one that you should be considering, and that is your TSP contributions. If both of you are putting in 5% of your salaries, that would reduce your income, and you now would be falling into the 22% tax bracket. So as shown in this example, you can see that it brings you down one whole tax bracket. But again, remember, you're still being taxed everything below that. It was just that portion, almost about $9,000, that you would be taxing in the 22 to 24% number because of that extra income. While this does help you, it isn't a massive change. On the other hand, if you had more income coming in from either the sale of assets or something else, it would be pushing you higher into that 24% tax bracket, and you would be paying more at that 24% rate, meaning that any income above your salaries is at the highest rate that you're paying, which is 24, and could go into that 32% level, but that would be a lot before you hit a 32% level as a married couple. The other type of tax I want to briefly talk about is capital gains. Now, you've already been taxed on your income, and now what we're looking at is your assets and the growth of your assets. There are two basic rates to be taxed for capital gains on a long-term basis. And again, remember, this is long-term, anything more than 12 months. The first rate is 15%, which goes all the way up to $500,000 of income for a married couple. Once you pass that $500,000 of income, you would go into the 20% rate. Now, most of the clients that I work with are below that $500,000 range, so it's very rare that I would even see the 20%, and it's very rare that most of you will probably see that 20%. But it may happen, so you should be aware of it. Now, you have to look that this is the long-term capital gains of assets that you have held for over 12 months, and certain ones don't qualify for that either. But anything below 12 months would go back to that marginal rate. So this is where it might be added on top of your salary and taxed at that 24% rate. Certain things like dividends from bank accounts or certificates of deposits would go into here. Other types of assets that you distribute, like monies from your IRA or something else, would also go into the marginal rate. The first way that you can save a lot of money on the taxes is looking at municipal bonds. Now, a municipal bond is a state or local government bond, and the taxation is that you'd pay no federal income tax or capital gains on the income that is generated from the portfolio. If the portfolio increases because of a capital gain, you will have to pay a capital gains tax. There's also something called the alternative minimum tax, and it may affect you in a small portion of some of your municipal bonds, but it is a little bit more of a complex subject. Just know there could be one other tax that's out there. But for the most part, on a municipal bond, what you're doing is getting the income from that bond because you're investing back into the local government. Now, if it is outside of your state, you might have to still pay state income tax depending on your state and what the requirements are in your state. But on the federal side, there is no tax on the income, which this is really good. Now, the rates might be a little bit lower because of this tax benefit, but there are some times that municipal bonds even outperform corporate bonds or even federal bonds that are taxable on the federal side. When would a municipal bond be appropriate would be is if you have a lot of cash or non-retirement assets and you're a very conservative type of investor. Many federal employees keep way too much cash on hand, and a municipal bond might be a great alternative for some of the banking products that you have. Now, you still want to make sure that you have good reserves and that they're stable and they meet your needs. But a municipal bond could be that next level of reserve. You're getting tax advantages and you're also not getting an extremely risky portfolio. When you're looking at municipal bonds, you do have to be concerned that you're not investing in just one geographic area or one type of bond. You still have to make sure you're diversifying. Municipal bonds are very complex, and there's also not a lot of information about what they are. If you were to compare a municipal bond to, say, a corporate bond has a lot of information available to the general public, where a municipal bond, most of that information you can't find. So when you are looking at this type of investment, please get some guidance or know what you're doing versus just investing, because you could lose all of your investment if you invest in the wrong type of municipal bond. The next area that we want to talk about is what a lot of people look at for tax-free income. And this is the Roth IRA. Now, the Roth IRA is a great vehicle for tax-free growth, but you need to look at how to maximize this. And one of the ways is to get a very aggressive investment. If you get a very aggressive investment, that means the growth of that money is not taxable and you're maximizing this out. In some of our other videos, when we talk about allocation or asset allocation and how to position this is one of the things you have to be considering. That your Roth IRA is a very aggressive portion of your overall asset allocation, and because of this, you could really take some good benefits on the tax side. The example that I talked about before, the GS12 Step 6, would not qualify for Roth contributions on an annual basis. As a federal employee, you are lucky because you can put money into the Roth component of your TSP. But again, there are limitations as well. I do talk about this in the TSP in retirement and the TSP asset allocation videos. The other thing that you want to be able to look at is that you could do what's called a backdoor Roth. Now, what this is you make a contribution to a non-deductible IRA, and then at some point in the future, you might convert that over to a Roth. Now, a non-deductible IRA, you're not getting any deduction. So remember how I talked about the TSP reducing your overall income? You wouldn't get that from this, but if you put it into a Roth IRA, you wouldn't pay tax on the growth going forward. So this could be a very good vehicle for the future and can be used for other options. There's one type of account that is only available to federal employees, and more specifically, it's only available to the CSRS employees. So if you are one of those types of employees, please listen up. There's a voluntary contribution plan. Now, what this allows is 10% of all of your earnings over the period of service with the federal government to go into this plan. Once it's in the voluntary contribution plan, you have two options, or when you want to take the money out, you have two options. You can annuitize it to go over the rest of your life, or you can convert it into a Roth IRA. Now, this is money that you've already paid taxes on, so it has to be out of the IRA or TSP system. But if you take this money, you can convert it to a Roth IRA and pay no taxes on the growth of that money forever. You also don't have to require minimum distributions. This is an extremely great plan, and unfortunately, for one reason or another, a lot of federal employees that meet the qualifications of the CSRS pension do not take advantage of the voluntary contribution plan. But if you are, please look at this account before you retire, because you have to set it up before you retire. As a federal employee, you need to protect your pension for your spouse in case you were to pass away. One of those options is a survivor benefit plan. But unfortunately, both the premiums you pay and the benefit your spouse receives are both taxable. There are other alternatives. You could use life insurance, which unfortunately the premiums are taxable, but the benefit is tax-free. You definitely have to consider if the survivor benefit plan or life insurance is better. Now, to clarify, we get no commissions for selling life insurance, so that's not what I'm trying to get you to do, is to buy more life insurance. I'm truly trying to make sure that you're considering all of your options and you understand what's best for you, and life insurance is the most beneficial for tax purposes. With the survivor benefit plan, though, you do have to consider your FEHB, and if your spouse is not a federal employee, you might need the survivor benefit plan so your spouse can get FEHB once you pass away, if you pass away first. The final area I see many federal employees overpaying for is on their health insurance, and not specifically on the premiums they pay for their health insurance, but not having an HSA or health savings account. By having an HSA, you might be able to put a lot of money away that you can reduce some of your cost for healthcare, but also through retirement, you pay for Medicare or FEHB premiums with pre-tax dollars versus after-tax dollars. So you might not see this right away as a tax benefit, but down the road, this could be extremely beneficial for you. I do want you to take consideration of looking at it. And now an HSA is required to have a high deductible health insurance plan. So that might not be beneficial for you at this point. But if your life changes, you definitely want to consider it. And every year when you have the opportunity in open season, take a look to see if your changes or the changes to the plan warrant you getting a high deductible plan and taking full advantage of a health savings account so it can save you a lot of money in the future on taxes. Summarizing today's episode, we covered areas where I commonly see federal employees overpaying for taxes. Hopefully you can take advantage of a couple of these ideas. We want you to do the best that you can for you and your family, so please get conflict-free, unbiased advice. Thank you for your time today, and we look forward to helping you in the next episode.